Markets are falling across the board, but in this episode, we unpack what's really going on, why it's not all bad news, and what smart Kiwi investors should be doing instead.
We're back in your life. Markets have dropped from Wall Street to the NZX. In this episode, we break down Trump is talking about tariffs. It is very stressful for a lot of investors, and we will tell Kiwi investors exactly what they should do. Now, we are using this episode today, Mike, for two reasons.
Yep.
One is as a podcast. Funnily enough, you can find it on Spotify, YouTube, Apple. Make sure to subscribe, give us a review, all that good stuff. But also for our investment clients, because I think it's really important. While I'm actually quite proud, I haven't had one phone call from a client really concerned.
That's why you changed your number last week. I like it.
Yeah. No, just do not disturb. The
voicemails are through the roof. Yeah.
But I got poor Alex in the background getting all the calls forwarded to him. But I think it's really important to over communicate in this scenario. So we're also going to send out like an email with this link to clients. So Mike, it has been a crazy few weeks, hasn't it?
Yeah, it has been a crazy few weeks. And I guess it's actually been a crazy start to the year if you look at everything going back to the last 3 months. But what we're talking about today is really the impact of the trade policy and the Trump tariffs that the US is putting out into the world. We'll talk about what's happening, why it's happened, and basically what to do next. Now, remember, this is not personalized financial advice. We're just talking in general terms. So, James, what has happened? How much has the share market dropped?
You ready for a crazy stat, Mike?
Rock and roll.
Wall Street has lost $5 trillion in a week.
Yeah.
So that's not good. The S&P 500 is down 13% year to date. The NASDAQ is down 20%. And a little old New Zealand, the NZX 50 is down 10% year to date. So some pretty volatile numbers, biggest drops we've seen since COVID.
So we know kind of the headline as to what's going on, which is Trump has introduced tariffs. But why does this mean that everything is dropping?
So if we think about it, Mike, what does a tariff actually do? And I know you've kind of got the economist side too. You like to kind of play up that piece. Let me ask you, when we talk about tariffs and essentially going, we're going to be charging people if they're trying to sell their products into the US, why does it impact businesses?
Yeah, cool. So it impacts business globally because of the size of the US. No disrespect to the Cayman Islands. But if the Cayman Islands introduce global tariffs of 10% on everyone, yeah, it'd be news, but it's not going to rock the core of the financial system. Because the US is the world's largest economy and is the reserve currency globally, and it's a lot of people's major trading partner or largest trading partner, every time they do something, it has flow-on impacts to the rest of the economy, right? If they introduce a 10% tariff for everyone, that makes everyone who sells their goods in the US 10% more expensive compared to US produced goods, right? Now, there's a lot of reasons why you introduce tariffs. A lot of them these days, though, are basically political reasons, right? There's no real argument for kind of trade tariffs anymore from an economic perspective. There's some infant industry maybe, but that's about it.
Yeah. You won't be able to find an economist out there who will say this is a good idea.
And previously, like 1800s, a lot of tariffs, right? But as the global market becomes more connected and trade becomes a lot more freer around the globe, tariffs are really not something you see anymore. Like no one's introducing tariffs unless it's for a political reason. Political reason might be it's the WTO or a whole lot of countries telling another country off, Russia, some countries in the UAE, Cuba, those sorts of things. Or it might be, I'm trying to think of another political reason. Or it might be a new politician comes in and he's promised a whole lot of people a lot of things. And maybe he has a really certain way of negotiating on things. And these are one of the actions that he takes to start those negotiations on the right foot for America.
Yeah, that kind of protectionist policy, right?
100%, right? And you kind of can get that from the States at the moment because they're calling them reciprocal tariffs. I'm not sure what they're reciprocating. If you look at the math, they're like, China's got a 67% tariff and we're going to give them a 30-something% tariff, something like that. It looks like what they've done is kind of taken the trade difference, the trade imbalance, halved it, and then called that the tariff. And then they're trying to respond to that. So The initial numbers of the tariffs that the states have from other countries is completely off. It's fabricated.
So if we look at some of the tariff numbers, so the baseline is 10%. New Zealand is within that 10% as well. Essentially, I was talking to a few people this morning on the drive-in, and the viewers were like, what's the strategy for New Zealand? They're like, we're just hoping everybody forgets we exist. We're the bottom of the country.
Absolutely.
Nobody notices that we're here. China, you mentioned, is at 34%. The EU is at 20%. Cambodia's at 49%. Mike, I have noticed a few like Vietnam, Cambodia, Sri Lanka have higher tariffs. Some people might go like, why are we beating up on those guys? Why is that?
Their sources of production, right? So what you're looking at there is locations in the global economy where you have really cheap labor. And it used to be that China had really cheap labor, and then they got a middle class that started emerging. So that labor is getting slowly more expensive. It's then shifted to India. They will get a middle class that will be more expensive. So these are kind of the next places where you expect to see cheap labor. And there are a lot of factories in there producing a lot of goods, a lot of textiles, these sorts of things.
So there's two implications of tariffs. The first one is inflation, which, Mike, I thought we were done talking about inflation. I don't want to talk about it again. But fundamentally, if things are 10% plus more expensive, right, that means that in terms of a consumer's discretionary income, they've got more going towards these goods. They've got less money to invest, spend in other areas. That gets the whole economy moving.
The inflation's a short-term thing, though, for tariffs. It's not a prolonged period of inflation. And I would say that actually the inflation is not going to come from imported goods into America being more expensive. I think it will come from American companies raising their prices so that they can effectively get a higher margin on their goods.
Okay. And the second piece is around business confidence.
Yeah.
So if you are a business and you're trying to plan for the future, you're thinking about opening another factory or opening in a new market or hiring an additional staff member, how the hell are you meant to be making decisions about the profitability of your business growing when these tariffs are out there? Everybody really has no idea what's going to happen. Business confidence is completely shot at the moment because people just don't know.
Yeah, 100%. And it was looking up, but business confidence in New Zealand was looking up. When I was talking to Jared Kerr the other day, he was saying this. However, people aren't making investment decisions even though they're a little bit more optimistic, right? Like people are still going, yeah, I'm confident, but I'm restructuring down and I'm still reducing people hours and I'm still doing the kind of retraction reactions even though my sentiment has changed.
So that is fundamentally, if you think about the share market, right? The share market is just companies selling products, selling goods. Essentially, Wall Street and investors have gone, I'm not as confident. And really the share market, Mike, the share market has all of the news of today. And when new news comes into the market, that is what's happened right now. And people go, no, well, this is bad. And a sell-off has happened.
Yeah, absolutely. And markets are forward-looking. Right. So remember, markets are not looking backwards. They're not looking at today. They are looking what's happening 6 months, 1 year, 2 years, 5 years, 10 years from now. So every time you get a decision or an action or an impact that is going to affect things going forward, markets will reprice straight away. And what you're seeing as people sell their stocks because they don't want to be in these high risk assets, they might want to go to a cash position or sell out into or buy into a flight to safety. So, some like more high quality assets, less risk. You will see as they sell, the price drops down. So other people sell because they get scared. It kind of creates a self-fulfilling prophecy where because people are selling, more people selling, that drives the price down. So more people sell again. And that's what you'll see in the markets.
Yeah. The other thing is I'm a bit worried about the headlines and people looking at the headlines and thinking that directly impacts me. So after this break, we're going to talk to you about what the headlines actually mean and then what Kiwi investors should do. Worried about how this market affects your investments? When the markets are up, people aren't as worried about having a financial advisor, but this is where the right investments are really important. Lighthouse Wealth is here to make sure that you are in the right investments to achieve your goals at the right stage of your life. If that sounds like you want to have a chat, get in touch via the show notes below. Now, back to the episode.
So James, let's say I've got some of my money managed by either Lighthouse or other fund managers, and I'm in kind of a balanced portfolio. What does that mean for me at the moment?
So I think the headline number of like a 20% drop in the market, maybe moving towards a bear market, people go, oh, if I've got $1 million, I've lost 200,000. But this is where the risk profiling that you should be doing, opposed to just chasing returns at the start, is really important. The whole idea, like when we talk to clients, we onboard clients, I go, it's not if the market drops, it's when the market drops. And when it does drop, how big of a drop are you comfortable with? So if you are all invested into shares, and we have done an episode which will pop in the show notes around if you should be invested just in the S&P 500, I think that's a really good example, Mike, of while the S&P 500 has a lot of companies that are very global, you can see the impact of one person and the risk it can have on your investments for the future. But if we look and go, okay, if we're not just invested in shares in the US, but say we're in a balanced risk profile. A balanced risk profile, the idea is we're not moving with the ups and the downs of the share market as much. We're having more of like a steady journey. So that's 60% in shares and property, globally, not just in the US, not just in New Zealand, and 40% in cash and bonds. Do you want me to talk you through, Mike, some of the numbers over the last month for a balanced portfolio?
Talk me through some of the numbers over the last month for a balanced portfolio, James.
So Australasian shares is the starting point, right? So we're hearing these top lines of 13%, 20%. Australasian shares over the last month have gone back 6%. Global shares have gone back 9%. And then the interesting part though, Mike, is when we look at bonds. So bonds have not gone backwards, bonds have gone forwards, because as interest rates continue to go all over the place, bonds become more attractive. If you've got like a 7% bond and interest rates go lower, you go like, oh, that looks good, Mike. I wouldn't mind a bit of that. And the value goes up.
Yeah, absolutely right. So bonds are kind of a safe asset, and they have a counter-cyclical way of moving to the market in terms of interest rates. So because there is economic uncertainty, we are expecting the official cash rate to go lower, right? And that's already priced into the market. I think it's down to 2.65 now, is what it's priced in at long term, which generally means those bonds, like James said, at 7% are going to look a lot better in the long run. So that's why your bond portfolios are increasing.
So, and then these bonds over the last 12 months are doing actually like kind of 7.5%, which is quite attractive.
Fixed interest, sexy.
I know, it's come back around. They're just like all things, right? You can't just go on the flavor of the month. You've got to have a well-constructed portfolio that's built over the long term. So a balanced portfolio over the last month, it has gone backwards about 4.5%.
Yeah.
And don't get me wrong, that is a big number that gets people worried. But when we talk to clients and we onboard them and go, hey, a balanced investment in a global financial crisis can drop 15%. So we're well within that threshold. But we just got to be careful of looking at the headlines and go, oh, this is really bad, because it might not necessarily impact your investments the same way.
Yeah, and I think it's a really good point is when you're thinking about investing into the markets, into funds, into property, into anything, you've got to make sure you can handle the risk of what you're going into, and you've got to make sure you know what the risk of what you're going into is. It's really easy to say to someone, oh, the market will go up, it'll go down. Are you fine with that? Yeah, most people in theory are fine with that. When you put it into numbers, people will actually think, okay, am I going to be able to handle this drop? And if I can't, don't go into it.
Yeah, I think the other thing, which is a little bit hard to get your head around, I appreciate, but markets dropping in value is not actually always a bad thing.
Yeah.
And I'll give you 3 examples of why. Firstly, if you're a buyer. If you're a buyer, it's a huge win. Lower prices mean that your money buys you more. Say you're at the supermarket, you get a 15% discount. You can get that around you. You can get your head around that. It's the exact same thing with shares. If you knew shares were going to go up tomorrow, you would 100% buy, but it's the uncertainty that makes you worried. So for buyers, it's a huge win. Kiwi saver contributors, it's a huge win. We're constantly regularly investing as well.
Yeah. And for one of the key investors globally, Warren Buffett, he is holding $334 billion in cash right now. So who is going to be out shopping? Him.
Yeah, and I think that's a big thing with billionaires at the moment is they're really going, this is a huge opportunity and you need to be thinking the same sort of way. So we're happy for a buyer. Mike, the next group is if you're not selling or buying, it's still an opportunity, because within your portfolios, you can talk to your financial advisor and you can rebalance the portfolio. So those bonds that have performed really well, we can rebalance, we can sell some of those off and buy those undervalued shares.
Yeah.
So there's still opportunity within there. And then the last piece is if you're a seller. So say if you did have a short-term goal, well, this is exactly why you've got cash and bonds within your portfolio, or at least you should, is to make sure that you don't experience all the volatility of just the share market. So there is quite a few wins for a lot of groups out there.
Yeah, absolutely. So James, before we wrap it up, I'm going to ask you one question. What should Kiwi investors do right now?
My advice is if you have a short-term goal, you should panic. Because if you've got a goal over the next 12 months, if you want to buy a house or something like that, you should never have been in these assets in the first place. The problem is you're going to go, well, I'm just going to stay in and wait. But there's no guarantee it's going to get, and I know people don't want to hear this, there's no guarantee it gets better before it gets worse.
Yeah.
So we're really taking a punt of going, what's going to happen in over a 12-month period, and good luck with those decisions. But if you're a long-term investor, let's just talk about the last, 30 years, right? .com, 9/11, GFC, COVID, and now tariffs.
Yeah.
These things happen, unfortunately, all the time. And there's all these little things that happen within those as well, like the Greek bailout. There's, China's growth rate was a concern at one point. The thing is, we don't know whether this is a big one in terms of history or whether this is just going to be oh, you remember that thing that happened and then it kind of all got sorted out. So my advice is do nothing.
Yeah.
If you've got cash, amazing time to be buying and taking the discount available in the market. But if you get emotional when the market moves like this, the only thing I would suggest is maybe we need to reassess your risk profile. So are you actually comfortable in a growth or a balance or whatever portfolio you might be, but also appreciating that it's just going to continue to be volatile, the markets going forward. If markets didn't have risk, everybody would take the 10% return, but the 10% return would never be there in the first place.
Yeah. My prediction on this is that actually this is a negotiating front and all of this blows over in about 4 weeks.
Look, I can certainly see how you get to that conclusion. I think I've talked to a lot of people about this, and the piece that people are struggling with is it's just one person and he's quite boisterous with the way he kind of goes about things, and we're not too sure, but he is known for his negotiation skills, right?
100%. He had an entire TV show centered around it.
Yeah. So for my investment clients out there, this is a way to communicate and kind of give our thoughts on what's happening at the moment. If you've got any concerns at all, please contact us. We're more than happy to have a chat, talk through how you're feeling, talk about what's happening in the markets. For all those that are watching, thank you very much for watching. Much love to Lighthouse for sponsoring this episode. Please subscribe to the channel, give us a review, give us a like, and we'll catch you next time.
Cheers.